Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. In the last video, we looked at Citigroup's key ratios and its valuations. In this video, we'll review Bank of America. Many famous value investors such as Charlie Munger, Warren Buffett, Lee Lu, and Guy Spear hold Bank of America in their portfolios. In this video, we'll review the company's key ratios and try to find the intrinsic value of Bank of America. So let's dive in and review Bank of America. Hey guys, I'm on QuickFS looking at Bank of America. You can see that the company's current market cap is about $227 billion. Looking at the business description, Bank of America, through its subsidiaries, provides banking and financial products and services for industrial customers, small and middle market businesses, institutional investors, large corporations, and governments worldwide. Bank of America operates in about 6 business segments, and the business segment that brought in the most revenue in 2023 was its consumer banking segment. The consumer banking segment brought in about 39% of the company's 2023 revenue, which equates to about $39 billion. Next, looking at the key statistics, the company's current PE ratio is at 8.0. The price to book is at 0.8, which clearly tells us that the company is currently trading below its book value. The price to sales is at 2.3. Next, looking at the return on equity, we can see that over the past 5 years, the company's return on equity has been about 10%. The return on equity gives an idea of what kind of return can we expect as shareholders to get on this investment. The 10-year median return on equity is about 6.8%. Next, looking at the key statistics, first is the net interest income. The net interest income is calculated by having interest income minus interest expense. So it's the amount of money that the company makes by charging someone an interest minus all the interest that the company has to pay out. For example, on your checking account, the interest that the company has to pay out would be considered an interest expense. So the difference between what it makes minus what it pays is the net interest income. Back in 2013, the company's net interest income was about $42 billion, and for the year 2022, it's about $52 billion. Over the past 10 years, the company's interest income has slowly been trending upwards. The net interest margin is equal to the net interest income divided by its total assets. So it gives us an idea of what kind of return is the company getting on its total assets in the form of interest. Back in 2013, the company's net interest margin was about 2.6%, and for the year 2022, it was about 2.2%. Over the past 10 years, the company's net interest margin has stayed fairly consistent, hovering between about 2 to 3% range. The competitor JP Morgan's net interest margin is about 2.4%, and the industry average for U.S. banks in Q1 of 2023 is about 3%. Next is the return on assets. The return on assets is simply the ratio of net income divided by the company's total assets. Back in 2013, the company's return on assets was about 0.5%, and for the year 2022, it's 0.9%. JP Morgan's return on assets for the year 2022 was 1%. So we can see that the company's return on assets is in line with its competitor. Next is the return on equity. The return on equity is the ratio of the company's income to its shareholders' equity. Back in 2013, the company's return on equity was at 4.9%, and for the year 2022, it's at 10.1%. Ideally, we want to see companies to have high return on equity numbers while making sure that the company is not overly leveraged. Next, we have the loans to deposit ratio. This ratio gives an idea of the percentage of the company's loans that the company funds through its deposits. Back in 2013, the company's loans to deposit ratio was at 81.7%, and for the year 2022, it's about 53.8%. So what this means is for the year 2022, every dollar that the company had in deposits, it loaned out about 54 cents. Over the past 10 years, the company's loans to deposit ratio has been trending down. There are 2 ways to look at this downward trend in loans to deposit ratio. The first is the company is being more conservative now with its deposits than it was 10 years ago. Second, by not loaning out more of its deposits, it is going to make less money. So the revenue is going to suffer because it's not loaning out more of its deposits. JP Morgan's loans to deposit ratio for the year 2022 was 48.5%. So Bank of America's loans to deposit ratio is a tad bit higher than its competitor. Next, we have the loan loss reserve to loans ratio. This is the amount of money that the company has set aside in the forms of reserves in case the loan is unable to be paid back or defaults. So higher loan loss reserves to loan ratio tells us that the company would be better able to sustain itself in economic downturn when more of its loans would be defaulted. Back in 2013, the company's loan loss reserves to loans ratio was at 1.9%, and for the year 2022, it's at 1.2%. Over the past 10 years, the company's loan loss reserve to loan ratio has hovered between 1 to 2%, which is in line with its competitors. Next is the asset to equity ratio. This is a leverage ratio, so it tells us how much debt the company has on its balance sheet. From a banking standpoint, the banks are required to have a leverage ratio of 5% or higher. In other words, the asset to equity ratio cannot exceed more than 20. Back in 2013, the company's asset to equity was at 9.0, and for the year 2022, it's at 11.2. Over the past 10 years, the company's asset to equity ratio has slowly trended up. JP Morgan's asset to equity was at 12.5, and Citigroup's asset to equity is at 12.0. So Bank of America's asset to equity ratio is fairly in line with its competitors. Next, looking at the company's earnings per share. Over the past 10 years, the company's earnings per share have also trended up. Back in 2013, the company's earnings per share was at 90 cents, and for the year 2022, it's at $3.19 per share. Finally, looking at the dividends per share. Back in 2013, the company paid out about 4 cents per share as dividend, and for the year 2022, it paid out about 86 cents per share as dividend. Over the past 10 years, we can see that Bank of America not only consistently paid out dividends, but it hiked its dividends every year for the past 10 years. Now let's look at the company's income statement to get a better understanding of the company's shares outstanding and its intrinsic value. Back in 2013, the company had about 11.5 billion shares outstanding, and for the trailing 12 months, the company has about 8.16 billion shares outstanding. We can see that over the past 10 years, the company's shares outstanding numbers have trended down, which tells us that the company's management has been buying back its shares. This is good news for existing shareholders, as when a company buys back its stock, the existing shareholders' ownership within the company goes up. Next, in order to find the intrinsic value, I'll use Bank of America's net income numbers. I won't be using the free cash flow numbers because banking is completely different than a traditional business, and net income is likely to give me a better estimate of the company's intrinsic value than the company's free cash flow. Now, just like how I found the intrinsic value for Citigroup, I will be using the no-growth perpetuity formula for Bank of America as well. I will be using the 2022 number of $27.5 billion. I'll divide this by a discount rate, which in my case, I'll use 10%. So what that turns out is $27.5 billion divided by 10% discount rate is equal to $275 billion. Now what this means is if Bank of America were not to grow from now into perpetuity, in other words, if it made $27.5 billion every year from now into perpetuity, then its intrinsic value would come out to about $275 billion. Now, if we compare this $275 billion with the company's current market cap, which is about $227 billion, we can see that the company's market cap is lower than the company's intrinsic value. In other words, Bank of America is an undervalued security. The difference between the intrinsic value and the market cap comes out to about $48 billion, which is about 17.5%. So using a conservative estimate of a zero-growth perpetuity model, the company's intrinsic value came out to about $275 billion. And with that, we can see that the company's current market cap is about 17.5% below its intrinsic value. Finally, let's glance over Data Roma and look at some of the super investors who have Bank of America in their portfolio. Charlie Munger, Lee Lu, Guy Spier, and Warren Buffett being the famous people. Lee Lu and Warren Buffett most recently bought more shares of Bank of America. Hey guys, that is all I had for you this week. Hopefully you found this video on Bank of America interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.